Guten Morning, my name is Christopher Belly. Tax season's almost over, yes it is. Then I'll still have to go to work, but at least I'll have my weekends again. Woo! Welcome back to Strong Man Personal Finance, everybody. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And I just watched a very interesting video this morning by none other than Jeremy LaFoofoo. You know, that guy that smells like poo-poo. You know, because LaFoofoo rhymes with poo-poo. So, Jeremy is my arch nemesis, okay? And I'm probably his arch nemesis too, even though he doesn't admit it. He even has a little tracker. If you go look in his the details of his videos, probably next to all his new sponsorships because he's bleeding money, he has a VT versus his small cap stock tracker. Very funny, very hilarious. You know, I've got, what, 5,000 subscribers. So, I use Jeremy as a great example of a idiot, a terrible investor, to educate you on what things are bad, what things you should not do, and what things you should do. Jeremy's a perfect example of someone that makes massive errors all the freaking time. Now, I say all the time, you need to understand financial statements before you consider buying stocks, okay? You don't need to be a financial genius, but you need to know the freaking basics, okay? You need to know what the financial statements are, where you can find them, and the full statements. You need to know how to reference the notes to the financial statements. You need to know your way a little bit around 10K. You need to know some basic stuff, okay? Because how are you actually going to analyze a stock without understanding the financials, okay? Now, a lot of you people don't care about that. You just invest, you know. Well, this stock went down a lot, and stocks always go up, so I'm going to buy the dip. A lot of you do that. You know you do that. But if you want to own a stock for the long term and you want to assign some value to it, some buy point to it, you have to understand the financial statements. Now, Jeremy, I don't know, last night, this morning, released a video where he clarified his investing philosophy. And oh my God, there was a very juicy tidbit in there where he talked about what his favorite financial statement is. And specifically, what account on that financial statement is his favorite. You want to guess which one that is? The balance sheet! It's the balance sheet! So Jeremy said the balance sheet is the most important part of helping you decide whether you should buy a stock or not. And he specifically only talked about the company's cash position. Now, don't get me wrong, cash is important because you got to pay your freaking bills, obviously. So you want to consider the company's cash, whether they have positive cash flows, negative cash flows. When you're analyzing a company, you want to make sure they can actually pay their current liabilities with the cash that they have, or their receivables and marketable securities. But Jeremy makes it seem like the balance sheet is the only thing that matters. And that actually makes perfect sense about what he does. All right? Now, besides the balance sheet, the two big ones are the income statement, which shows the company's profit or loss on the accrual basis of accounting, okay? Has nothing to do with cash. I mean, obviously there's cash in a business, but the accrual basis of accounting, you recognize revenue when it's earned, and you recognize expenses when they are incurred. For example, I'm gonna come cut your grass. Which grass am I talking about? So I come cut your grass. I have done the service, okay? I cut your grass. Even if you haven't paid me, I cut your grass. I have recognized, or I will recognize on the accrual basis of accounting, revenue. So when you see a revenue on a company's income statement, assuming they're on the accrual basis of accounting, which most big companies, well, all of them should be, that means they've performed services, but that doesn't necessarily mean they've got the cash. So you have the income statement, which shows profit and loss on the accrual basis of accounting. And then you have the statement of cash flows. Now, the statement of cash flows is all about cash. It shows you what cash the company started with, what happened, where the cash went, And there's 3 big categories: operations, investing, and financing, and how you got to your ending cash position year over year or period over period. And let me tell you, you need to actually look at those too, okay? Pulling up a financial statement or a 10K and looking at financial statements and literally just going to the balance sheet and looking at cash, that's the dumbest thing I ever freaking heard. Now, case in point, if you think I'm twisting Jeremy's words, let's talk about a company that Jeremy was pumping. And I'm sure they had a great cash position. But if you had failed to look at the statement of cash flows, you would not understand that the cash position was actually not good. This company was very good food company. Now, I remember looking at it, and this company was burning cash hand over fist. It was freaking ridiculous, okay? And I said, man, if they don't change anything or sell assets or raise money, they're gonna burn their cash in a couple of months. And all I had to do was look at the statement of cash flows, and do some analysis. But if I had just went and looked at the balance sheet, the cash position, how would I have known that the company was burning that cash at a massive freaking rate, okay? Now, Jeremy had no idea. And what happened was, a very good food company, they had to have a massive share issuance to raise money to stay alive. Now, Jeremy was just shocked. What? Jeremy was just shocked that very good food company had a massive share issuance and they diluted the shareholders. When all he had to freaking do was look at the statement of cash flows and he would have seen that that was inevitable, okay? Jesus Christ, Jeremy. The guy's a disaster, all right? Sure, the balance sheet's important. Absolutely. You should look at everything. But you can't just fixate on the freaking balance sheet, okay? Another thing he said is, debt doesn't really matter. You don't have to worry about debt so much because interest rates are low. Now, he caught himself a little bit because I'm sure we all know interest rates are going up. So if you see a company that has a massive debt load and their debt is maturing, it's coming due in the next year or two, you need to be very careful because let's say they have $1 billion in debt and they're paying 1% now. Well, that's like what? It's too early for math. 10 million. But what if interest rates go up to 5%? Okay. Well, instead of paying 10 million, hope my math's right, I'm freaking early. Instead of paying 10 million, they got to pay $50 million as an example. All right. You got to be really careful with debt. You can't just look at cash and ignore everything else except that. All right. So be very careful with companies that are burning cash. You can look at the statement of cash flows. And be careful of companies that have massive debt loads, which, it doesn't matter. Interest rates are low. Especially if their debt is maturing in 2023, 2024, yada, yada, yada. Be very, very careful. All right. God. And he went into some more stuff about it. Actually, I'll make another video about that later. But, God, that guy's a clown. All right, well, that's it. I'll make another video about that video he made because he actually addressed something else very interesting. But for now, I'm going to go to work because I have a job like a loser. Talk to you later. Ciao.